On this episode of Deep in the Heart of Taxes, looking for a work-at-home tax break? Well, here's the bad news. Also, President Trump says that he will review universities' tax-exempt status. The number one habit of highly successful taxpayers, and low taxes for a limited time only. This being the tax day of 2020, you'll want to stay tuned. All right. Howdy, fellow tax nerds, and welcome to Deep in the Heart of Taxes, the only show that boils down all of the relevant tax law news that's fit to share, and some of it that isn't, all so that you don't have to. I'm your host, Jack Manhire.
I'm your co-host, Carrie Fox.
And I'm your other co-host, Dr. Tyler Kyle.
Okay, thank you very much. Let's get on to the headlines real fast.
Jack.
Yes, Carrie, go ahead.
Real fast, before we get to the headlines.
Yes, go ahead.
I have one question, really more of a point of order than anything else.
Okay, go ahead.
Okay, why am I the co-host?
I'm not sure what you mean.
Well, I mean, you told me to introduce myself as co-host, and you were your host, Jack Manhire. I'm your co-host, Carrie Fox.
Yes, okay.
But why am I just a co-host, not the host?
Well, largely because it's my show, and I simply invited you to be on to help out a little bit.
Okay, but I mean, he's a co-host too, and it kind of puts us on the same, the same level. I think you know what I mean.
I really don't. Can you elaborate?
Okay. Here it is straight, Jack. I understand why you might want to call him a co-host. I mean, he really doesn't know anything about tax whatsoever. And Jack, really, we all know that your knowledge of taxes is really skeletal at best, okay? I'm the tax expert here. I'm the one that maybe I should be the host, and you should be the co-host. Or perhaps we both be the co-hosts.
Okay, I'll tell you what, Carrie. We're casting right now. Why don't we meet on this after the cast? And we can make a decision, okay?
Okay, no, that's fine. That's fine. I just wanted to get it on the record, so to speak.
That's fine. We'll have a meeting afterward, and we'll get it all settled out. We'll all get it figured out.
Okay, and I will be in that meeting, correct?
Well, of course you're going to be in the meeting. I just invited you to the meeting.
Okay, it's just that if I'm not in a meeting, I'm very, very concerned that there won't be anybody competent there to be able to handle the issues of the meeting.
Carrie, you'll be in the meeting, okay? So again, why don't we table that and we'll get to the headlines. Over at Paul Caron's Tax Prof blog, our good friend Brian Camp from Texas Tech University's Law School.
Yes, I know Brian very, very, very well.
I'm sorry, I do not have the pleasure of knowing the gentleman. Yes, well, Brian is a great guy, but he wrote in the Tax Prof blog, quote, Lessons from the Tax Court, the number one habit of highly successful taxpayers. And the case that he reviews is Michael K. Simpson and Cynthia R. Simpson v. Commissioner, which is a July 7th, 2020 case. Now, he does a really good job, of course, of reviewing the case, but in the front of the blog, he does an excellent job of covering what he calls the rule of 62s. That's sections 262, 162, and 62 of the Internal Revenue Code. And as he reminds us, Section 262 prohibits deductions for personal expenses. Section 162 permits deductions for expenses sufficiently related to trade or business. And Section 62 tells you whether it is allowable to take those deductions above or below the line, so to speak.
Yeah, Jack, why are you reading that? I don't understand.
Well, I'm just reading the blog.
I know, but don't you know that? I mean, 262, 162, 62. In fact, doesn't everybody know that who's listening?
Well, maybe they do, maybe they don't. I think Brian did an excellent job doing a good comprehensive review, and some of the people that listen to us aren't necessarily tax experts.
That is true, madam. Some of the people that I recommend this to are not tax experts.
Well, some of the people that you recommend this to, I don't even understand English, okay?
All right, let's knock that off. But again, Brian does a great job here covering the rule of 62s and talks about a highly successful taxpayer will know the difference between unreimbursed and reimbursed employee expenses and whether they do go, in fact, above or below the line. As he says, careful accounting is probably the number one habit of highly successful taxpayers. If you're looking for a tax break as you struggle to get in your tax returns before midnight tonight, here's an opinion article from Bloomberg Opinion saying, looking for a work-at-home tax break? Here is the bad news. And as so many of us have been working from home for probably at least the last 4 months or so, we've had to invest in some things. We've had to invest in ergonomic chairs. We've had to invest perhaps in laptops or other equipment. Certainly a good deal of our high-speed internet is being used for business purposes. And some people may immediately be thinking, I should be able to write these off as work from home expenses. But the article does a fantastic job of outlining what people who think that might be missing. It goes on to say, unfortunately for most taxpayers and employees, or anyone who receives a W-2 form for that matter, that is a fantasy to think that. The 2017 tax law eliminated the federal write-offs previously allowed for unreimbursed business expenses and home offices, along with most other miscellaneous itemized deductions. Come on, spit it out. I'm sorry. Okay. Thank you very much for covering me. The thinking was that a doubling of the standard deduction would help offset the pain of ending or capping itemized deductions, but that was done before the coronavirus. Now, a very few lucky employees, such as struggling performing artists, can still qualify for a business expense tax break, but it's a narrow group, and it seems unlikely that the U.S. Congress is going to widen it. So again, if in fact you are thinking that you're going to write these things off because you are an employee, meaning a W-2 employee, working from home under the current tax law, you might want to think again. Matthew Kuplan over at Forbes has a very interesting article entitled Low Taxes for a Limited Time Only. The article goes on to say, as many of you may already know, taxes in our great nation are at an all-time low. If you look at it historically, paying taxes now is arguably better for most Americans today than it ever has been. This is thanks in large part to the Tax Cuts and Jobs Act of 2017. In it, our federal tax brackets expanded and lowered to their current levels. That change in law, however, has a couple of noteworthy points. The first one being that it's set to quote-unquote expire after 8 years and revert back to the higher rates that preceded it. And the second point is it can preemptively be altered by the government if the people making the rules choose to do so. So put simply, if the party in power shifts to be different than the one that put this law into place, you can rightfully question the law's future. So in general, when you think about that and other current taxation rules, it's good to note that capital gains taxes, which you do pay on investments not associated with your tax-deferred retirement accounts, are at different and sometimes significantly lower levels than income taxes. This is good for you if you need to pay them. Also, the estate tax is as friendly now as it's ever been. If you are a married couple and you die with an estate of under $23.16 million or $11.58 million for an individual, you're not subject to your estate having to pay taxes on any of it. And finally, in the wake of the most recent economic correction that occurred because of the the affliction pandemic, our government spent a lot of money to protect businesses and citizens. This will need to be paid for by someone at some point, and I think you can guess what that might mean. Okay, so what's the point? The article goes on to say, net, it's impossible to know with certainty but the author believes that it's fair to assume taxes will be going up from the levels they are at today. If that's the case, and you believe it's true as well, then in knowing so, how do we plan for our future and its income sources and streams? One option, Matthew goes on to say, is to strongly consider doing a Roth conversion of the retirement assets, which consists of changing the tax structure of your pre-tax retirement accounts, which you haven't paid taxes on yet, but will in the future when you spend the money, to a post-tax retirement account, also known as a Roth account, thanks to former Delaware Senator William Roth, who proposed it in Congress. Now, in doing so, you will have to pay taxes today on the amount you move over or convert. So, for example, if you have a $500,000 individual retirement account or a 401k plan, and you want to convert $25,000 of it to a Roth for this year, you can do so. But this year, that amount of $25,000 will be added to your current year income. You have to pay taxes on it when you go to file your tax return today, unless you got an extension, then it's October. There's no way around that. But the idea is that paying those taxes today at the potentially lower rate and being quote unquote done with ever having to worry about paying the taxes on that money again in the future, which might be at a higher rate, if you're willing to take that bet, it could be incredibly powerful long term. Matthew goes on to say there are many other things to consider when doing a Roth conversion, and it's best to consult your tax professional along with financial advisors. Yada, 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 disclaimer, 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 disclaimer. But again, overall, a very good article by Matthew Coupland in Forbes. Jack, are you going to go on to talk about that hacking story that you mentioned to us previously?
Yes, I rarely agree with Dr. Kyle, but I think that is actually an interesting story you should cover, Jack.
You think so? I mean, it's a little spicy for it.
Well, a little spicy, but law seems to have gotten spicy these days as far as law practice. I'm not a lawyer, but I know many lawyers.
And you play one on TV, perhaps?
No, ma'am, I don't. That's very funny, though. Okay. All right. If you think so, I'll just give it real fast, and I'll give the little summary. From law.com, here's the headline. Hacker streams porn into a Florida court hearing by infiltrating Zoom. Again, bizarre and disturbing. But here's the summary. Quote, it began like any other court hearing over Zoom, but this lawsuit challenging Leon County's affliction mask order took an X-rated turn Friday morning. While Florida attorneys prepared to present their legal arguments, hackers infiltrated with bursts of music and a strange sort of rap involving offensive language, then began streaming offensive visual images. You can read more about that because I'm not going to necessarily talk about it on law.com. We'll call that the From the Fringe story for the day.
That's fine. Story from the Fringe sounds good.
I agree. That sounds good. Thank you very much. I appreciate it. But what do you think? Let us know in the comments section below. And also, please include your comments on the other stories, especially on the IRA election for this year. You think it's a smart move? Is it something that you would do or that you would advise your clients or your students to do? I'm really interested in knowing what you think. All right, so that's our show for today. If you liked it, please hit the like button, the thumbs up button, and share it onto your other platforms. Again, Facebook is the one that gives us the widest possible audience. Also, be sure to subscribe and hit the bell icon to be notified of future shows so that you can take part in our live chats. Thanks for listening today to Deep in the Heart of Taxes. I'm Jack Manhire.
I'm Carrie Fox.
And I'm Dr. Tyler Kyle.
Wishing you many happy returns.
Okay, can we have that meeting?